An investment in knowledge pays the best interest. Studies show that when individuals have knowledge in personal finance, they're more likely to contribute to their local communities and their local economy. When people do not have that personal finance knowledge, they start to experience financial burdens, and those burdens can put a lot of added pressure on their communities. Today, I want us to look at personal finance knowledge from a few different angles. For those of you that are looking to get some higher education, did you know that the average amount of student loan debt at graduation last year was $32,731, and that the average loan payment every month is $393? Let's say you borrow $12,000 for tuition for your first year of college from the government at the average federal interest rate of 4%. So $12,000 at 4% seems pretty straightforward. When you sign for that loan, you agree to a payoff schedule that starts usually the year that you graduate. And if you follow that schedule, you end up paying back $14,579.30 for the $12,000 that you borrowed your freshman year. So that's about $2,500 that goes back to your lender in interest for letting you borrow that money. By the time most people pay off their student loans, following those payback plans from their lenders, they generally end up paying 34% more in interest on average than they borrowed, according to the Federal Reserve. From that perspective, would you take on the loan and borrow the $12,000 for school each year? My question today is this: does the average American student receive the financial education that they need to understand how loans work when they go to borrow later in life? The Council for Economic Education conducted a survey this year, and they found that only 21 states actually require high school students to take a personal finance course. That's less than half of the United States. Yet borrowing money is a practice that's passed generationally because it has worked for many of our parents and our grandparents. It's a very common practice. How you make your financial decisions is also passed along generationally from your family. It's shaped by both direct and indirect lessons about money. Direct lessons like having a responsible spending discussion, or opening bank accounts, or talking about how to balance a checkbook. And indirect lessons such as watching a friend purchase the most stylish clothes every month, or having a parent unemployed for a period of time, or seeing medical bills come in from a family member dealing with an illness. Those indirect lessons are often more impactful than your direct ones, and they are full of emotion. To get rid of the emotion from your financial decision-making, you need the right support and the right tools. Educating ourselves on personal finance and setting some financial goals every single year is a really great first step. Only about 2/3 of Americans actually even try to create a budget, according to Fidelity. But budgeting and creating a plan and keeping track of your money is a really good way to guide you in using your financial resources effectively. The education that you are working on, that in personal finance, begins to train your mind to have a positive emotion related to money because you feel more invested in your decisions and more confident. But you still need to find a way to remove the emotional decision-making from your financial world. And technology, I argue, can be a way to do that. It can show you how certain activities are going to enhance your finances and how others are going to be more detrimental. Think of it as like a financial GPS. When we're driving and we're using a traditional GPS software, it directs us to where we want to go, and it tells us how each turn is going to affect your arrival time and your distance to the destination. For example, you're driving down Main Street and it directs you to take a right onto Water Street, but you miss the turn because you're rocking out to the radio. So the GPS then recalculates and it directs you to take a right onto Roxbury, and it will get you to your destination maybe a minute later, it tells you. It doesn't care that you don't drive down one of those streets it directs you to because it reminds you of your grandma. It's going to send you on that route that is the fastest or the shortest distance. This type of software, this GPS that we use when we're driving, is a software that is powered by algorithms, which are built on mathematics. And it's the same type or same basis, this software that improves our lives, as this type of financial GPS I'm talking about. Now, when your finances are really simple, it's very easy for you to calculate how one purchase is going to affect your personal goals. But as you take on more loans and grow throughout your life and you have life changes, your finances are going to get a lot more complex, and there become more ways for you to pay off of those loans. So factorials are a math concept that these algorithms are built on. Factorials outline the number of sequences there are for paying off those loans, and they're a simple multiplication product of the number of items in a combination. To show you or to illustrate, if you have 3 student loans, let's say, that's 3 factorial. So 3 factorial, the factorial being the exclamation point that you see, but 3 factorial is very simply 1 times 2 times 3, and the product is 6. So there are 6 different sequences that you could use to pay off your loans. And because there's only 6, you could probably figure it out pretty easily as to how or which one is the most efficient and the fastest. But let's say after you graduate with those student loans, you want to buy a car so you can get to your new job. So you are then looking at 4 factorial. 4 factorial being, give me a second, 1 times 2 times 3 times 4. So you multiply it by 4 off of 3 factorial, and that's 24. So you have 24 different ways to calculate how to pay off those 4 loans. Now let's say a few years pass by and you're still paying those off, but you decide that you are going to buy a house. So you now have 5 loans, or 5 factorial. So 1 times 2 times 3 times 4 times 5 is 120. So you can really see how it starts to add up very quickly and get a lot more complex. Now let's take a look, and let's say you open up a credit card. So now you have 6 different loans. 6 factorial is actually 720. So some of us may be math whizzes, some of us may not be, but I don't think anyone wants to sit down and look at 720 different combinations or sequences that you could follow to pay off those 6 loans and figure out which one is the most efficient and which one is going to get you to 0 debt the fastest. So I argue that using this financial GPS is only going to benefit you because it will do the calculations for you. It will help you not leave it up to guesswork, but it'll tell you how each purchase affects those goals that you have set for yourself back when we were doing our financial knowledge. Now, not everyone is going to have the right knowledge and the right tools, and they're more likely to have financial burdens if you do not seek out that knowledge, especially if you aren't taught it in school. So when you have financial burdens, as I mentioned, it can put a lot of pressure on a community. For example, when an individual defaults on their car loan because they don't know how to properly manage their finances, that can affect a small business because that individual can't get to and from their job. When a recent college graduate has a lot of student loan debt, they have a lot of trouble saving to put money down on a home. So you see, it creates this ripple effect. If 50% of your community had the personal finance knowledge to make good financial decisions, do you think that community would be thriving or just surviving? With a community full of financially knowledgeable families, that could be a really thriving community. Individuals and families that have skills and strong networks and some savings are more resilient to hardships like periods of unemployment. Individuals like that start businesses and restaurants and community-focused organizations. They source goods locally and they collaborate. So if you couple that technology like this financial GPS, with the growth mindset activities, like reading about personal finance and attending seminars at your bank and talking about money with your family, you start to manage your finances better and you create these positive money experiences. Now, 100% of you listening already are or will become the personal finance decision makers of your own life. The quality of your decisions is directly impacted by your knowledge of personal finance and the tools that you put to use. So that has a direct impact on the people in your circle and in your community. So when you're next considering borrowing money or perhaps financing a car, I want you to remember that saying, an investment in knowledge pays the best interest. Take the time to educate yourselves on how it will affect your financial goals. Understand the true cost of that loan. And think about how your decision will affect your community. Thank you.